You vote? Did you vote for Elon to step down?
I did not vote, but I would have if I did.
You would have if you did. Yeah, that makes sense. If you voted, that you would have voted.
I would have voted to have him step down if I had voted, but I didn't vote. They said in the article today, 70% of advertisers have not advertised on Twitter in the last month.
Yeah, it's not good for their revenues. Whoopsies. I guess if you
And
fire
90%, what was the number? 89% of revenue came from ads.
I'm happy he's stepping away. I just want him, and this is, I'm sharing an opinion that I heard and agree with. I want him to focus on bigger items when compared to social networks.
Want him to focus on which part? The boring, the underground tunnels? You want him on the SpaceX?
Dude, all that innovation, all that, those big problems. I want to have a vacation on the moon, Elon.
Welcome to episode 27, Talk Your Chart. Brett Horowitz here with Marco Segura. Today is December 23rd, 2 days before Christmas. Happy early Christmas, Marcos. Happy Hanukkah.
All the things.
You know what has not been good lately is what the consumer is going through. Retail sales numbers. We're seeing some signs and cracking a little bit that the consumer is not spending as much as they were in the past. So the first chart I have up here is GDP. Why GDP? Because 68.4% of GDP is made up by consumption.
Okay.
And so when that drops, that's why GDP drops.
Consumer to the rescue. Consumer to the rescue.
I tell myself every time I travel, every time I eat out, I'm taking one for the team. I'm doing it for the economy because the economy really needs my consumption.
You're right. Retail sales are down, but you can't tell if you go to a mall or to a restaurant.
Right.
Everyone's still out there. We'll talk about credit card debt in a little while, but you're right. The retail sales are down, but people still have cash, and people anecdotally still look like they're spending all of it.
I'm sure it's the have and the have-nots, right? I mean, it's hard to notice unless it's a really deep recession when something's happening or when demand is down, because people that have the cash are still spending and the people that don't are really tightening the belt.
Yeah, I agree with you that we have a bad representation. You saw that real GDP growth for Q3 was revised up to 3.2, right? Mm-hmm. So where's that recession, huh? Where is it?
Well, as we mentioned before, GDP growth is not the actual definition of a recession. Even though everyone seems to think
just part of it, just part of it,
right? So on the next slide here, we've got a chart showing all the determinants that the National Bureau of Economic Research puts into account to determine what is a recession. NBER, exactly.
Okay.
So we have personal income, we have spending, we have production, we have employment, all of things. What I was shocked at looking at this chart was how fast these things change from red to green or green to red from month to month. It's not like it goes from bright green to pale green to yellow flashing and then red. It sometimes goes from bright green to dark red.
But wait a second, look at when was that? Because I was like, wait a second, what happened in the middle of this chart? But COVID.
Yeah.
Generally there's some gradation, but it's hilarious how COVID is all Christmas colors. Yeah.
And how fast it bounced back right after that.
I know. Don't think that's happening this time.
So we've got lots of pale greens and some light greens. So right now things are doing okay. I guess the only one that's like a pale red is the industrial production.
Is this through August?
It's through August 2022. Yeah.
Or September. Yeah, it says September. Okay, guys. So we're a little behind, but yeah, I wonder what that looks like now. Why is real wholesale retail sales white? It's okay. It means they probably don't exist or something. Cooling off, right? I think cooling off is the answer.
And as we said, it needs to happen, right? We've been way too hot for way too long. These things have to come down. It's just a matter of how far they come down.
Yeah. Okay. So this is perfect. Next chart, probability of a recession in the next 4 quarters. So I am on the record on this little show we have. So listener, we know you're out there. I'm on record. I said it. I thought recession next year. Why do I think a recession won't happen next year? Because look at this chart. Everyone thinks a recession is going to happen next year, right? So this is, why does the market think the Fed will do much less next year, meaning a lot less cutting? A chart like this, which is the Philadelphia Federal Reserve study, These are all the professional forecasters that are, again, only right 40% of the time. Probability of recession the next year is the highest in the 50 plus years this survey has been conducted.
Well, I guarantee every one of them that's right is going to tout how great their prediction skills are. And everyone that's wrong, you're going to forget that they made that prediction.
It's
But
incredible. I would have thought it only would have been second to COVID because that was so obvious a recession because we did it intentionally, which rolls right into this next chart, which is another graph. This is economists. So this is a similar monthly survey that Bloomberg did. 70 economists shows the probability of a recession is even higher than what we just looked at. This is showing 63%. What's funny is you look at COVID, that's when it was 100%, right? The survey began in 2008. Only time it's been higher is in COVID, right? 2020, when it was 100% probability.
I'm surprised though that both these charts, the number is not even higher. Because as we said before, there's not a single person in the world that's not talking about it. All the media is talking about it, all the companies are talking about it. A 45% number on the first chart, to me, it even seems low. I'm surprised we're not in the 80 to 90% range.
Look, but time out. Wait a second. I don't think you can look at it just as a 43. You have to look at it on a relative basis compared to all the other readings.
I get that. Yeah, I get that.
And it flies off the charts. So I think that's the signal, right? Everyone's obviously expecting it, and we'll see what happens. What's funny is if we don't get a recession, markets are not going to like that. Why? Because if we don't get a recession, the Fed probably is higher for longer and perhaps tightening even more, which will be bad for risk assets.
Well, but I think back to January of this year, where everybody was so gung-ho about how things were going. Right? We had the last 3 years were phenomenal. January 3rd, we had another record new high. Like no one could have predicted what 2022 would look like. And so I feel like I like to take the contrarian look at it. Say if everyone's negative, I'm kind of positive, because we've seen from corporate earnings in the last week, if you got a miss, but it's not as bad as people think, your stock is going to rally. And that's what I feel like we're looking at here. If
it's all
not
expectations.
As bad as everyone thinks. Yeah, expectations.
Yeah. I think the problem with the earnings is going to be that we've seen the multiple contraction, right? So the amount an investor is willing to pay for earnings has come down, but the actual earnings figure hasn't come down yet meaningfully. So that's a surprise we might get beginning of next year.
Well, we'll see. We'll see if it does or not. Like, I mean, all this is about predicting the future.
All right.
That's the bottom line.
You got a 10-year chart for us?
Yeah, we've talked on this show before, and it seems to be one of the most common misperceptions is that when we talk about interest rates rising, everyone says, well, we know interest rates are rising. The Fed keeps telling us they're going to raise interest rates. And I kind of always have to take a step back and explain to people, the Fed is raising interest rates. That's an overnight lending rate that is not the same as the 10-year rate, which is determining mortgages and car loans and things like that. And you can see here that over the last few months, rates have come down on the 10-year treasury, even though the Fed has raised rates on their end.
I know. That's the market not believing the Fed, right? If you plotted this for the 10-year, excuse me, not just for the 10-year, but for from 2 to 30, you see a lot of the same thing, kind of rates coming down. What's interesting is now you have, right, the Fed funds rate, your target is now higher than the 10-year, right? So now you end up with a 4.25, 450 Fed funds and a 10-year that's below that. The key is going to be, when does the forward CPI print get under Fed funds? That's what people are looking at historically.
The last few months, we've had 0.1s, 0.2s, and 0.3s. I know everyone.
How does that annualize? Annualize that.
Right, it's low.
What is it? I don't. You're the calculator here, not me.
Well, you're 1.2 to 3.6 if you analyze those, but everyone looks at the headline of 7 and said that's still too high because that's
backwards. That already happened, Brett.
I know.
That already happened.
I agree.
I know. So yeah, we need a good print. Doesn't the PCE come out this morning? I didn't even see it.
No idea.
I didn't see it. Okay, so we're continuing the Fed talk here. Gosh, Jerome, there's Paul staring at you from behind me. Excuse me. All right, what the Fed says versus what the market has priced in. I think this is super important because I think the divergence here, specifically the divergence between the blue line, which is what the Fed has been insisting is what's going to happen, and the orange and green line, which is what the market is pricing in. And if you look at, let's just go to the most right point of the chart that talks about December of next year. Blue line says the Fed funds rate will be at 5.125%. The market is saying 4.4. Why is there a divergence? Because the market is pricing in recession next year that leads to Fed cutting rates. Fed saying it's not going to happen. The market's calling its bluff. Who wins? Who turns first? Who blinks first, Brett?
Look, the Fed, we've heard from them in the last few conferences how roughly half of the people in the Fed thinks they're moving too slow and half think they're moving too fast. So there's disagreement in there as to whether we don't want to make a mistake of the 70s and 80s where we took our foot off the pedal, we lowered rates, inflation spiked a second time, and now it becomes more part of society. But on the other hand, almost every single time we have a recession, why does it stem from? It stems from rates going up too high. So I think it's easy to sit back and say they're doing something wrong, and at the end of the day, Monday morning quarterback them. But it's not a perfect instrument they're using to try to affect inflation.
No, it's definitely blunt force, and who knows if they've overcorrected it, but it definitely feels like they have. Let's see if they actually allow. They said it right. They said the instrument they're using has a lagged effect. Let's see if they actually allow time to pass before something happens.
Well, but they've gotten most of the pieces down, right? We've got the housing has come down. All of this stuff with the supply chain has started working itself out. We've had low numbers. Wage increases is the big one that hasn't come down yet.
But here's the problem, and I don't know if you can fix it without doing the thing that they're trying to do, which is get people fired, which sounds crazy to me. Where you have like all these people finally back to work, things are looking good. The Fed has been trying to do that, and now they're saying, no, we need to get people fired.
Well, my favorite question from clients that I really can't answer is, why is it better that people lose jobs than to have high inflation? Right? Isn't it okay if we just have 3 or 4% inflation for a little while?
You can give them some books to read and some historical examples about how inflation is absolute killer of all good things. And without a doubt, you would rather have the short-term pain of the few than a long-term pain for all. That's obviously fire people versus deal with a spiraling out of control of prices.
But why does inflation have to be 3%? Who came up with
No. So different story. Yes, I agree with you. Why do we need to get to this 2% average? Let inflation run a bit above average for the next 10 years, just like it ran below average for the previous 10.
That's what the Fed said they were okay.
I don't know. But look, if the soft landing is engineered, I still don't think it will be, and I still am holding to next year. It's going to be because of the consumer. Consumer to the rescue. You started it. I'm going to say it again. Here's what we're looking at now: household checking and savings deposits. Right now, Q2, it was so you still have trillions of dollars that are going on there. If we look at the lines, all they're talking about is, yeah, it's come down. But look at the tagged line, the choppy line, the notched line. Gosh, whatever the name for that
dotted
type of line.
It's called a dotted line.
Is it dotted? All right, I'll go dotted. All right, dotted line, whatever. The dotted line, that was the trend. Look how far off trend we still are. People still have a ton of money. People still have it. So if we get a soft landing or even a mild recession, consumer to the rescue again. It doesn't mean more helicopter money.
Doesn't this look like the stock market for the last 10 years?
Yeah, it kind of does.
Increase, especially in the last few years. It's come down a little bit. And a lot of people are looking at it going, man, I lost so much money this year. This number's down. But look where it was 3 years ago.
I know. I get it. And let's roll this right into, okay, so money's coming down. Okay, fine. Cash on hand coming down. So what has everyone been talking about too? Oh, but I hear credit card balances have been coming up. So let's take a look at consumer debt. Without a doubt, debt service ratios have come up. What's a debt service ratio, right? It's just the amount of money each month out of your discretionary cash that you have to send towards debt service, right? So if you look at 07 is basically where this thing starts, that's not good. That was super high. Why do we know that's not good? Just because of what happened during that period of time. That's clearly come down. And look where we are now. Can everyone, again, stop trying to read the book with their nose on the page? Yes, credit card debt is going up. That's what happened. It's always secular, but we're early in the game, early in the game. And the chart's not here, but people talk about mortgage debt. The quality of the borrowers are so much better
Oh, yeah.
than what was around before. We've already talked about that though. But anyways, this I think this does a good job of putting in perspective where we are in the credit cycle.
Well, I mean, the debt going down has been helped by the low interest rates, as we all know. Banks are being a lot more forthcoming and intelligent when they're giving out the loans. I still worry down here in South Florida, you still worry about all the people that have a lot of money going towards rent. You know, rent's such a giant piece now of the puzzle. So hopefully that comes down. But yeah, this is good news. We shouldn't look at the last couple of quarters and go, oh my God, I know this is a big cause for concern.
Yeah, I think there's plenty of time, right? Okay, we talked about employment. Our next chart here is unemployment. We were looking at this and joking, it's kind of busy. I think the easiest way to look at this chart is if you again go all the way to the right and you see where all the lines end. It starts with May, goes up to June as you work your way up the colored lines. And basically all this is saying is starting in May of 2022 up till November of 2022, economists have simply been forecasting a higher inflation print a year from that moment in time, right? So in December of 2023, economists think, and did I say inflation? Because I meant unemployment.
Right.
Economists think unemployment is going to be 4.6%. Is that good or is that bad? I don't know, but it's higher. Is that what the Fed wants? I guess.
It's at a 50-year low now. And week by week, we look at the unemployment figures out every Thursday, and they go up by 1,000 or 2,000. We're down by 2,000. I mean, they haven't moved at all. Maybe at some point they will move. I continue to say, who's laying off employees when everyone doesn't have enough employees, right? When there's more jobs than there are employees, we need people. So I don't know, maybe you don't pay them as much. I don't see these widespread layoffs happening. Maybe it does end up happening and the snowball's out of control. But right now, like 4.6 is just normal. I mean, where we are now is way too low.
Yeah, still to $10.3 million, 10.3 million job openings. Remember that was like at 11.3. So it's come down a million, but still.
It also doesn't help. You and I talked before the episode about the fact that the population growth in the US is not going up very much either.
That was a good stat. What was that stat you gave?
We had 0.4% population growth this year. We had 1.3 million, I think, more people than the start of the year, end of the year than start of the year. But of that, 1 million were immigrants, or not immigrants, but people moving here from other places. And only 300,000 were due to births. And we had 24 states out of 50 where we had more deaths than births.
Yeah.
So Europe's facing that already. Asia's facing that. If that hits us too, that's not going to help this equation.
Yeah. Look, if there's one message we can get out there to the 2 or 3 millennials and Gen Zers that are watching us right now, go out there and make a baby.
Oh, it's going to be some cold weather this weekend. Lots of free time.
Do it for your country. Do it for your country.
Lots of free time this weekend with the cold weather.
I know.
Watch some football.
Look, next chart. Give the shout out. Give it to him. Give him the shout out.
Steve Holdis.
Steve.
He would want everyone to know you've got to stay invested, because if you take the pain, there will be recovery. There will be gain on the other end. You just got to be patient and wait 1, 3, 5, 10 years, whatever it may be. There's going to be a lot of gain going forward.
This chart is excellent, man. I love this. What's the number going to be? I don't know, but it's probably going to be positive, right?
Well, next episode, we get to go through our bets for the year, see how we all did, our predictions. And we're in 2023 already. Can you believe it?
I know. Brett, did you see? So last episode, maybe the one before that, I have JP Morgan, you have Verizon. You were crushing me. Crushing me. I had no chance. But have you seen the numbers to date?
I'm waiting for the end of the year. It's not.
You're behind, buddy. I have flipped the script. Oh my gosh. Jamie Dimon for the win.
Let's do this every year. Let's see how many times you're right.
Oh my gosh. All right. Brett Horowitz, Merry Christmas. Happy Hanukkah.
You too. Great 2023, Marcos. Let's keep doing this.
Yes, sir.